Thank you all for being here today. So my name is Pedro, Loureiro. I'm from KPMG. I'm glad to be here, and KPMG is glad to be partner of Fintech House for a long time. So today we'll be talking about ESG. I have here with me today Tiago, Andrade from Lynxai, correct?
Lynxai.
Yeah. Sonny, Masero from CAESAR.EARTH.
Hello.
And Espen, Husstad, sorry, from Claims Carbon. So I'll just ask you to briefly introduce yourselves to everyone, and we'll start from there.
I can start. So I'm not an engineer, so the first one, I think. I'm on the management part. So Lynxai, we help asset managers deal with ESG. Asset managers, investment firms, investment funds. First of all, and maybe what we are talking about here, regulations are pushing asset managers, especially in Europe, to deal with ESG. What we are doing is also that help them lead the way with regulations. So what we are doing is SFDR, I don't know if everyone knows what it is, but all the regulations in terms of ESG, we are doing this automatically. With the chunks of data there is already available, structured data, and as soon as we have the portfolio of the client, we can do the regulations and send to the client ready to send to the regulator, okay? So this is our first product, let's say. The end product is really around creating artificial intelligence and first of all machine learning around ESG. So bringing unstructured data to the structured data that already exists and try to create patterns to deal with ESG and prove that it can influence the financial markets. So that's what we are doing. Maybe we'll go deeper and deeper.
Thank you. Hi, I'm Sonny from CAESAR. And thank you all for staying for the most interesting topic in FinTech, which is ESG. One that is particularly controversial at the moment, but also impactful. And I've been working in this field for 25 years, so I now consider myself an expert in ESG and sustainability in finance. And what we're seeing in terms of regulation with ESG at the moment is a real drive to transparency. And that obviously comes with data, as we've already heard. And what CAESAR is doing is kind of looking at that issue of transparency and using open source satellite data to really reveal how real assets are performing. So we look at real assets, particularly farms and forests, and try to monitor that ESG performance and the associated risk. And that really gets over the hurdle that we have with ESG data at the moment, which is, we did a survey recently and 97% of investors and banks said that they were using ESG data, but only 11% felt that it was investment grade in terms of the quality of that data. So that is a real challenge that we're trying to solve.
So I'm Espen. I'm the Norwegian alibi here today. So you have someone also from that part of the world. So as a background, I guess I'm somewhat of a nerdy mathematician, sort of originally. But I've spent, I would say, the last 20 years I've had, C-level style positions in P&C insurance. I was heading up Aon, the largest broker in the Nordics, for a number of years. And I was also the CEO for a listed insurer for 5-6 years. Anyway, when I left that, I think now today it's more or less exactly 2 years ago since I paid €10, I think it was, €10 to register the domain claimscarbon.com, which is the company that I will be talking about. And what we are working on is the following, namely that something which I don't think many people know, but approximately 2% of all global carbon emissions, 2%, which is a big number. 2% of all global carbon emissions stem from material and energy associated with insurance claims, which is an enormously big figure. And we are making SaaS solutions for how to calculate and work with that and so forth. But we'll come back to that.
Yes. So So thank you all for your introduction. So I would say, and maybe going once again around, how you begin this ESG journey in your own view. I understand you have some different background, you have some different approaches, different clients, go to market, but a little bit how we see today in your own point of view.
Shall I start? Okay, so it's very interesting. When we hear COP 26, 27, everyone is now pushing, the last 3 years, pushing for financial market participants are going to be forced to change in terms of their investments, where they put the money so that it's more sustainable. So they are pushing in COP. Meanwhile, asset managers already promised a third of all assets under management to go to more sustainable companies, projects, or to the same companies, but pushing them to be more sustainable. So at the same time, we are seeing a big thing globally, let's say. Now, looking at Europe and United States, China has a different way of doing things. Let's not talk about that now. Europe and United States, it's different. Europe is pushing by regulations, forcing everyone to at least map what they are doing. That's what we are doing the last 2 years and the next 2 years probably. It's asset managers and the ones that are putting money in companies, at least mapping what they are doing in terms of sustainability. Then, at the same time, in the United States, because regulations or asset managers, maybe there it's a bit different, and it's also a very political thing in the United States. What they are doing is putting trillions of dollars in the economy for these projects and these companies, federal dollars, and because of that, capitalism forcing all the asset managers saying, well, if they put so much money, this is going to speed up. So different ways of doing this. I'm not saying that one is better than the other. I'm just saying that's what maybe is the way of starting the ESG on the money, let's say, which I believe it's a good way, because if the companies are seeing their investors saying, well, you should change something if you want my money still, or if my new money, I think it's a good way of starting. That's why I also created Lynxai to help asset managers to monitor and to have data on these companies. So that's how I would say it's how it begins.
Thanks. So just to build on that, when I'm talking to clients, whether that's asset managers or banks, the way to start is to get started, because ESG regulations, ESG as a topic, it's not going to go away. Despite all of the kind of anti-woke, anti-capitalism, anti-ESG movement in the US, this is not going to go away. The science is very clear when it comes to topics like climate change, like the destruction of nature, that we've got a limited time to act. So starting now, understanding what these topics mean, and figuring out what is financially material for your businesses is really fundamental. And that does start with data, so getting that transparency. But what we will see, I believe, is that ESG as a label may disappear, and we will see much more focus on specialist topics like climate change, like nature. We're already seeing these funds, specialist funds being set up to do that. We're looking at banks who are looking to decarbonize their lending. So that kind of focus is really key. And I think once you start on that journey, there is so much more information available today than there was definitely 25 years ago, but even 2 or 3 years ago, before there was this big push in regulation. And whilst Europe has set the standard in terms of the sustainable financial disclosure regulations, the US are going to publish 4 pieces of legislation this year, the SEC, and they've already written to a number of the financial institutions to say there is going to be more supervisory scrutiny on ESG claims as well. So this as a topic is not going away, so my recommendation would be to start.
Yeah, I agree. I think that's a good advice. What we are focusing on is the E, because we are sort of doing the climate part. And I think one of the sort of really big trends that we see now is really that any organization, they have to focus not only on their own sort of internal little emissions. An insurance company or a bank, they don't really have any emissions at all in their own small little operations, right? Insurance companies and banks are interesting from a climate perspective only when you look at them from a value chain perspective. It's where they are in the whole value chain that matters. And you know, the banks have known this for a long time, and asset managers and on that side, because you have something called financed emissions, which everyone is reporting on and I've been working on for a long time. You have the car industry. You know, if you look at the car producer, car manufacturer, their own emissions, they are like nothing. It's not interesting at all. The reason why the car industry is interesting is only from a climate perspective, is again when you look at the value chains. Because then they are obviously buying an enormous amount of steel and aluminum and stuff like that. And on the other hand, they have clients that have tailpipe emissions, which is extremely crucial. So, and the same we see in insurance, you know, that the claims, it's really where you use the insurance and then you have an enormous amount of emissions that no one has been focusing on. So I think the value chain, that's the key.
Thank you. We just saw before the other panel the regulatory burden and all the regulatory difficulties that the insurance companies have. You guys are on the other way, so you are leveraging on this regulatory, new regulation, ESG and everything. Besides that, what type of difficulties, you mentioned data, what are the main challenge that you have today or you feel that you have today?
You want to start now? Yeah.
Mix it up a little bit. So in terms of the challenges, I think on the data side, I think it's about quantifying the financial material impact of what's happening. And we are already seeing real assets, the value of real assets being affected by climate change, by the destruction of nature. And trying to get that visibility so you can make decisions is very hard. But what we're doing with satellite data is making that much more transparent. So from space, using open data, you can see whether there is a flood or whether there's been storm damage to a piece of real estate or a farm or a forest. But you can also look at the positive impact that those kind of assets are having. So is it storing carbon? Are the trees growing? Is there more biodiversity? And that kind of transparency really changes the market in terms of how you think about ESG, because ESG has been bogged down in the chase for data. Getting data from real assets, from buildings, from farms is very difficult. But if you can get that from space, with open data from the likes of ESA or NASA, that really changes the information that you can use for your investment or your financing decision making.
In terms of challenges, it's always around data now, because we need to prove that ESG is connected with financial impact in terms of stock prices and everything. So data is always an important aspect. But I think many people probably here are thinking also is private companies' data. Because the listed companies are obliged now to publish a lot of data on ESG. They are doing that. So it's easier and easier to get access to that data. One thing is to have access, the other thing is to organize it and to actually make actions around that. That's what we are trying to do now. But the big challenge is the big and private companies are not forced yet to publish that data. Maybe consultants are probably going to help there, because it's one by one thing after one thing. So that's probably a big challenge, because asset managers, if they really want to do, I'm talking about alternative investment funds, so investing on unlisted companies, they don't have this data to actually take action around it. And we are seeing most of them actually with some problems on regulations. Because they are forced to publish it, to report to the regulators at the same time. So maybe that is a challenge, but it's also a gold mine. If you have access or if you have data on private companies that is not public data, and remember that one investor invests in a specific company, but that specific company has a lot of investors usually, so you can actually serve to a lot of investors. That's also a gold mine. So a challenge, I would say it's a big opportunity.
I think the fundamental problem or challenge is that most of this ESG style data is really physical data, like on On the climate side, it would be physical stuff. I mean, materials and energy and stuff like that. Whilst, banks and insurance companies are, I mean, it's an industry that don't have any clue about physical things. We know about money, right? And financial assets. So all of these challenges with data, it's sort of, as I've seen it, it usually boils down to doing modeling where you are transferring physical stuff to financial stuff. And that's what you need for regulators also. I mean, if you are to calculate risk capital needed or stuff like that, it will always boiling down to monetizing something physical. And I think that's where you see all of the problems with the data, really. How do you collect and do that?
I think we have I think we have time for last question. Since you have different approaches, different views of these issues and all this ESG approach, I think we have one thing in common. So we are trying to bring to the investor, independent of the investor, if it's a company, a single name, everything, new information, a new type of information that will just be part of the equation for the final decision. So how do you think ESG at the end of the day will have an important role in decision one investment to another, not only the return or the risk and return of each one?
Well, I think on the stuff that we are working on, I mean, as we see it, the climate component, if you transfer that into a combined ratio equivalent, we're talking about an opportunity of 3 to 4 percentage points, which is huge. And, I think insurers should monetize that. And I think they will be able to do that, with our help, of course.
I think in terms of the opportunity there is the certainty for investors and for funders, in that we know, let's take climate change as one example, we know that we need to get to net zero emissions by 2050 and halfway there by 2030. So there is a predictability to that. That regulation will have to follow. It may lag, but it will follow. And the important thing about the regulation is that it's being asked for by investors. Investors want that transparency. So again, there is that momentum. So if you're raising funds to decarbonize real estate or to invest in forest and sustainable farming to store carbon, then you know that's going to happen. It's more about a question of time. And if you don't, we are already seeing transactions and prices of real estate being impacted as a result of inaction.
In the short term, so in the short term and long term, short term is if you release bonds for sustainable projects, you don't only pay less, these are about companies, but you also raise really fast. So in the short term, this is happening. It's happening. Well, the results of the stocks are for the long term because of what happened with Russia and oil. Everything changed. But also in the short term, the push for socially and regulatorily, the push for more sustainable projects, more sustainable companies, it's big already. In the long term, we are talking about environment is really on the long term, but social would be maybe on the medium term. And ESG, it's usually the three of them. So you really want to work on the social part also. So if you look at the long term, you see not only regulations coming, not only for investors, but for companies. So do you really want to invest in a company that's going to be regulated and they are failing on everything? Do you really want to invest on companies that are making a lot of damage in African countries, for example, and when that is discovered in Europe, the stocks go down? Do you really want to invest in companies that your LPs, the ones that give you the money, are not interested on putting the money? And I hope that changes. The United States is already changing, as it is very political. In New York, in San Francisco, they are not wanting to invest in companies that, for example, invest in weapons. And they realize that the pension funds, a big thing in the United States, are investing in things that they are totally against. So they are saying, well, my money is my vote also. So maybe medium long term, the asset managers, pension funds, investment firms are saying, well, be careful, because if we don't have solutions for at least the ones that are interested on climate and social and governance, of course, we will maybe be in more troubles. Of course, when the stock of all the oil companies goes and the profits are immense, in the short term, all of them changed. BlackRock was saying that they were cut. They invested immense amounts of money on oil because the profits are really big. So maybe on the short term it's more difficult. That's why it's also good, because we are creating still the products. So we don't need the solutions right now.
Thank you. I think we go to Q&A. One question.
From the Portuguese Ministry of Finance, I have a question. I was wondering if you feel this with your clients, because I somehow have the idea that we are focusing on what is green now, and we are leaving lots of stuff behind. And the risk that we may have is that we divest on those that should be transitioning, and we are only looking into those that are already somehow sustainability champions. So do you see this risk in asset management in the current landscape? And do you believe that maybe there is somehow a way to address this with more looking forward metrics, or somehow providing data that would allow to see more the impact and not only the immediate risk of a certain climate investment? Thank you.
There's a lot in that question. Can I answer it in 1 minute? I mean, I think the use of scenarios is very helpful in terms of understanding what those possible future outcomes might be and where to place money. But I'm being asked a lot by clients about how do they bring forward the future impacts and future risks into their decision making today. And at the moment, particularly for real assets, there is not a standard methodology by which you can do that. But all of my clients are looking for that at the moment. And I do think in most cases, they are all trying to engage with operations or with companies first before divesting. Some of them have set a time frame for when they are going to get out of fossil fuels, as an example, starting with coal. So that is already, and in the meantime, they are stepping that down, so reducing that within their portfolios. And then what we're seeing emerging now is new funds coming out that see the opportunity of transitioning those assets, because there's actually a stratification in the market. So the very largest investors are already thinking about how to dispose of the assets that are too risky. And they're getting rid of them into the market for two reasons. The cynical one is it's going to be too expensive to transition, and it's going to get stranded. And they want to do that before it's priced into the market, so they're going to offload it to somebody else. The second reason is that it just doesn't fit with their investment strategy. So if they have a core investment strategy where they don't have the money to invest to transition, then pass it on to somebody that can. And that's happening before the rest of the market wakes up. So there is a real danger, if you're not thinking about this, that you're going to acquire a high-risk asset, is the other real risk there.
If I may give one comment, I'm spending a bit of time with the Norwegian Oil Fund, which is a pretty big investor. I think they have actually calculated now that over the last few years, the transition risk has also on this as a stranded asset side has been pretty well captured in the market pricing already, meaning that from this time and onwards, you could look very positively at this and consider it being actually a pretty big opportunity and that that the downside risk already has been priced in. But we'll wait and see. But I think there are many views like that also out there, because people have obviously been pricing in a lot of this stuff already.
On the active ESG, which maybe it's what we are talking about, active ESG is really investing on companies that are not good. Engine number one, an asset manager in the United States, invested in Chevron, if I'm not mistaken, and they changed completely the board so that they do pressure on the CEO, and with help of BlackRock, Vanguard. And that's maybe looking at the future completely. Chevron is going to be one of the most polluting companies in the United States, in the world, for some time, but they still put the money there because they can change. So that's active ESG, activists. which is super looking to the future, super interesting. Maybe regulations are trying to push it in a short term, like, come on, do something, start with something. But I believe that in the long term, it's also being thought about. So yeah, I say it's our clients are really thinking on the long term. They're not in a hurry, only on regulations, but in a hurry to see data coming in and proof that it can influence the finance market.
I think we have no more time for questions, so thank you all. Hope you enjoy it, and thank you guys.
Thank you.